welcome back to SF Live. And if you haven't watched any of our other videos in 2023, a happy new year to everybody. We hope you started it off well. And of course, all the best and prosperity in 2023 and best of health, of course, as well. Thank you so much for joining us. We appreciate you taking the time. We have a couple more Outlook interviews and forecast interviews for 2023 lined up, recapping, of course, 2022 as well. And to sort of predict what it is leading to in the next 12 months. And we've got some great guests again on the show. Again, today we have Lobo Tiggre. Really looking forward to having him on. He's a self-proclaimed fundamentalist, and looking forward to his insights here on the markets, where where does he think things are going. We briefly chatted beforehand. And he's going to set the stage for us here as well. Alistair McLeod, Dave Morgan as well. So make sure to subscribe to the channel, because I know roughly 85 to 90% of you are not subscribed. What's up with that? Let's change that. Let's bring that number down. It helps us with the YouTube recommendations as well. Thank you so much for that. And without further ado, I've said enough. Let me introduce my guest, Lobo. It's great to see you again. Thanks for making the time, and Happy New Year, of course, to you as well.
Yes, Happy New Year, and a happy, healthy, and wealthy New Year to our audience as well.
That's the term I was looking for. Healthy and wealthy. That rolls off the tongue nicely. Appreciate. I'll steal that from now on. Thank you so much for that. No, appreciate you making the time. Of course, I'm sure things are ramping up here. My inbox was quiet yesterday, but it's starting to pick up pace here, and I haven't seen too many news releases from the miners, but we might get to the miners later. Let's recap 2022 real quick. You're a fundamentalist. I love that term. I watched your Kidco interview from about 2 weeks ago, and let's talk about the fundamentals of 2022. What has changed? Like, how did we leave 2022? Let's recap that to sort of set the stage for 2023, Lobo.
Sure. Well, the recap wouldn't be breathtakingly original, but it's worth reminding people who are pulling their hair out about prices not going where they think they should. And it seems to me every resource investor I know thinks one price or another isn't where it should be. But it's worth reminding ourselves that we were more right than anybody in the mainstream. We are in uncharted waters. We knew that. We've known that since 2008, but the 2020 shutdowns were a big reminder of that. And yet you had all these mainstream people, and this is relevant. You had all these mainstream people on Wall Street, and you had the Fed, central bankers around the world saying, but we're in uncharted waters, but here's our chart, and here's what we're going to do. And trust us, everything will be fine. Well, it wasn't fine. We knew that the fiscal and monetary response to the COVID shutdowns would be inflationary, and we were right. All right, now, flash forward to 2022, and it seems like things aren't right. Gold actually ended up the year a smidge up, but largely flat. You know, what happened? What went wrong with 2022? Well, actually, I don't think much went wrong with 2022 at all, given the world that we're in, a world of fiat currencies and a world of central bank intervention. The major drivers over the last 50 years for gold in particular has been real interest rates. And those did curve upwards. They're still negative, but they're less negative than they were before. And so for gold to actually have a sideways year in a year of fundamentally less negative interest rates and nominal negative interest rates disappearing around the world as well, that's really, I think it's quite bullish. It tells me there is serious appetite out there despite the headwinds. And of course, gold is priced in the dollars. We saw the dollar wrecking ball smashing all kinds of things, not just gold, not just commodities, but stocks and other things. So there's so much we can go in retrospective here, Kai. I don't want to be too long-winded. But actually, I think if you take a breath, take a step back and look at the big picture, 2022 was rather affirming of most of our fundamental theses here. Gold led, we saw what was coming, we were right, and the piper is still to be paid. And there's a pretty good chance that we'll see that in 2023.
Oh, absolutely. Let's stick with gold here for a second before we jump around, because we will jump around. There's so many topics that sort of intersect and cross each other's path there. But gold, yes, we held up, right? And but the year was interesting. Like we actually dropped. We were down quite a bit mid-year. We were down to 16.15. Well, and now we closed at about 18.15, like $200 higher. That's a really big swing for gold. Let's look at the reasons for that. Like, why did that change? And I know we talked mid-October at the New Orleans Investment Conference, and the DXY was at at its peak pretty much of the year, 114. We're now at 104, 105 right now. What is the reason? I know I already sort of felt like gave away the answer here, but what's your interpretation of what I just made out here?
Well, it's a couple things to remember or take away from that. One is we have confirmation that, and we've seen this in the past. In the early aughts, we saw it in the last big cycle. But the threat of the Fed hiking rates, the idea that the central bankers will increase interest rates, that often hits gold in particular harder than the actual rate hikes. And we have seen times when gold has rallied with rate hikes, as it has this last month or two. The interesting twist sort of for 2022 was that instead of rates portending where the dollar will be and therefore driving gold because gold is priced in dollars, or as I think of it, not the gold price, but the gold dollar exchange ratio, we saw the dollar trading pretty much since the outbreak of the war in Europe very directly with the dollar on Forex, the DXY. And that was an outlier, but it still remains in strength. And it really underscored what our friend Brent Johnson calls the dollar milkshake theory. And so, long story short, what we saw was that Brent was right. And while the dollar was rallying, that was bad for alternatives, including gold. And now we've seen dollar roll over and head down. And you know that it's kind of funny to have me on a show looking for predictions for 2023 because I avoid making predictions where possible. But I have been saying that I thought that the Fed led the way in tightening, would lead the way in loosening up, and therefore that would affect the dollar milkshake mechanism. It would go into reverse as the world perceived that the Fed was less hawkish than the ECB. And I think that's actually what we're seeing. I think that analysis was correct. Over the last couple of months, it has certainly benefited gold and silver bugs.
Oh, absolutely, yeah. U.S. dollar definitely trading lower. As a living in Germany using the euro, I'm happy that the euro is stronger again than the U.S. dollar. That we've left parity. Really happy about that because I traveled to the U.S. quite a bit.
And sorry, let me jump in and just real quick add on. And in the terms of looking forward to 2023, I think this is very bullish. I mean, I don't really believe anything a central banker says, but they are trying to provide guidance. And Lagarde did say that they're looking for steady, rate hikes going forward for some time. So, and steady at last is 50. So basically she's signaling at least 2 more 50s. And the Fed is signaling, maybe 50-25 or 25-0 or something. So we're seeing that play out. So actually, I think this is very bullish for early 2023. And then, who knows how the recession and everything else hits. But as a forward-looking statement, you've got me here in an unusual spot, Kai. I'm actually willing
I'm taking
to
advantage
almost make
of
a prediction.
No, it's interesting but Europe was late to the party raising as well. So of course there's a bit of a time delay in between because Lagarde was just like as you said, 2-3 months late raising after the US started raising rates already, right? And maybe to fill in, I looked at the Fed Watch tool just before we came on here for our interview, and the next Fed meeting is in 29 days, early February, and it looks like it's 70% prediction is a 25 basis point hike. So they're definitely letting steam out of the kettle or out of the pot here.
Well, again, that's the market, though. That's not based on Fed speak or whatever. The market is pretty aggressive in telling the Fed what it thinks it should do. I think that is pretty aggressive. Because they're really worried about a 1970s repeat, I think, and I would not pull 50 off the table. And if anything, the market sets itself up for pain. If the market rate really, if those odds go really low, and then the Fed does 50 and says, "Look, we said we still had a way to go," it would be a shock, right? That disappointment to the market would be a real blow. So, but the market, Mr. Market isn't one guy. I can't grab him by the lapels and say, "Listen, buddy." So we'll just see what happens.
Now it's interesting, like CPI numbers, and I'm having a bit of a deja vu moment because whenever we chat, CPI numbers in Germany come out. When we chatted in October, same day the CPI numbers came out, right? So again, today CPI numbers in Germany came out and they were below forecast, meaning our inflation number was way low, or not way lower, but I think predicted was 9%. We came out at 8.6, right? So There's
Right,
momentum
but
in
there's
that
also
direction, right?
I get that, but I would, and again, who knows? If central bankers, watch what they do, not what they say.
No,
But and what they do, by the way, is accumulate gold. But
true.
we have the circumstance for Germany with the energy prices and the gas coming down in Europe. Like they refilled, unusually warm winter, so there's an immediate short, like near term disinflationary force. And so it's in a way not surprising that the number should be lower than expected. But I think the powers that be understand that may not last. Like that I would, if I was in Lagarde's shoes, I'd fall down. But if I would not assume that this is sustainable, right? So we'll see.
Yeah, I think you mentioned extremely warm winter, right? Like New Year's Eve, I was wearing shorts. I think we're being saved by the weather here, or bailed out by the weather, if you want to say that as well. And here in Germany, at least. But again, deja vu moment, because I think I asked you the same question mid-October, because we had gold going up today, or we have gold going up today, intraday at least, and we have the DXY going up together. I know you're not a technical trader or an analyst, because I remember your answers like, well, Kai, I'm not a technical analyst, I don't look at it. But like there's that correlation again that is sort of off-putting, because it usually is the other way around. Either gold goes up and DXY goes down, or DXY goes up and gold goes down. Today they went up in tandem. Any meaning behind that? I know I asked you the same question mid-October.
Daily volatility. Let's see if I got the effects here. If it's still that way, it wasn't up that much. Yeah, no, it is. It's up 1%. That, as a fundamentalist, my response is that reads fear. Even though I'm not a TA, it's interesting. I have friends who are, and somebody, well, one of my researchers actually on the team pointed out that gold went up to 1850 and then came screeching back, and that if you look on the charts, that's a significant resistance level. Okay, maybe that is, but the DXY did turn at that point as well. There was, you can look at the mirror image. It's like a Rorschach. It's been since last February. It's been like a Rorschach blot, the gold chart and the DXY, which is why I call it the wrong trousers, because it's the wrong measure. I think you and I spoke about that before. But anyway, so the DXY trades on a much larger set of variables, a lot of different players in there. Some of them, they couldn't care less about what happens to gold. So to present the theory that gold bounced off of 1850 because that was a gold resistance line, but at the same time, it's clearly responding to the dollar, it seems to imply that the gold market is defining the dollar and everything else in the world. And that's too big a claim for me to accept, not without really hard evidence. So I don't know what the technicals portend, but if you see that line on the chart, and it does seem, it's hard to ignore when you see lines like that. Wow, it really does seem to run up into that barrier. Then if we can break through that 1850, which, the dollar perhaps, reversing could do, that could make for a very significant move in this month.
No, absolutely. I think it wants to break out. It just keeps bouncing off that level. What about silver? It keeps bouncing off the 24 level. It keeps trying to break through it from the bottom to higher levels, but it's bouncing off there as well. Is there same correlation, or is that anything else or something else driving silver?
Well, I'm happy to see silver moving on a daily basis more in response to gold than it had been for much of 2022. I was starting to get worried that my Darth Silver thesis would turn out to be more immediate than I thought. Darth Silver is saying that years down the road in the new gold standard, there may not be it may not be bimetallic, but the more heavily industrial aspect of silver really seemed to come to bear a lot more weight in 2022. And there were days when gold would be in the green and silver in the red, and then the opposite. A lot more than usual, it seems to me. But lately, since the dollar pivot, it seems like they've been moving more as they should, as monetary metals should, and that's reassuring. If you're betting on silver as a monetary metal, then seeing it move with gold is very important. If that relationship breaks down, well, then you really need to start looking at silver as being like a different color of copper. Fortunately for me, as a person with a lot of silver stocks, that hasn't happened yet. So I don't really have a technical comment there. My key point, though, is just to watch for the industrial aspect. as we head into or deeper into the recession. It'll be called in the future the recession of 2023, but we know it started already last year. But as the recession of 2023 deepens, that will be a headwind stronger for silver than for gold because of its industrial aspect. On the other hand, when we come out, when that's priced in, when people stop talking about will there be a recession, and it'll be, when will it stop, forward-looking market, and you've got China reopening, you could actually see silver do one of its zooms and way more than catch up with gold, later on this year as things turn around. There's kind of a forward-looking statement again there, Kai. I guess I'm saying, like, left to its own devices, we should be in for a long and deep recession, given the still knock-on effects from the COVID lockdowns, and now a war in Eastern Europe, and a new Iron Curtain going up all around the world, which isn't just Russia. There's the US-China divide too, right? So these things, they're not good for the economy. At the very least, they make it less efficient. We're looking at a higher cost world going forward. But the reason why I don't say that it's necessarily going to be a very long depression is because, or at least not immediately, is because I expect the powers that be to respond very quickly. I expect, even if the Fed proves tough, if Powell channels his inner Volcker for longer than I think he can, that won't stop the fiscal response from stepping in, because none of this will be any fault of the people's own, right? So, sorry, we got into the economic forecast there from silver, but the impact on silver was just watch out for that industrial aspect. It could hold it down as we head into the recession, and it could actually make it zoom ahead, depending on the response to the recession.
Actually, some of the thesis is already playing out. I just read it on Reuters this morning. I think is the UK that's already giving out money throughout the year to lower income households. I think it was £1,200 or £1,000 that are going to be distributed over the year. Not a big sum of money, but it's sort of a proof of concept what you just said, that the governments will sort of quantitative ease, like add some quantitative easing here, like on a there's like maybe on a populist level, right? Instead of and bail out maybe the I'm lacking the proper economic term here, but bailing out.
I get you, brother. I hear you. And the irony is that they're fighting inflation with inflation.
Exactly. That was the point I was trying to make, right? And
it sounds Kafkaesque. Like, how could it be so insane? But I mean, I flew out to California last year, and I got in and warmed up the YouTube, and it detected I was in California. And the first thing that popped up was an advertisement from Governor Newsom saying, I sent you a check for this, I sent you a check for that, I'm fighting inflation by sending you this money. And it's like, holy cow, how did the people not understand that too much money chasing after too few goods, and your response to that is throw more money at it? I mean, I understand that it hurts people. I understand that politicians are pandering to voters. But it's just
it's lunacy. Like,
clown world.
It's lunacy, to be honest. Like, if you look at it, you brought up the recession topic, and one of the questions I had noted down was recession versus stagflation, because usually recession is shorter, stagflation is usually longer and more painful, right? Do you want to elaborate on that? Like, how do you see that playing out, and how bad will it get? Unemployment number is one factor to look at, because that's something Powell looks at, and right now it hasn't really moved, that unemployment number. So this feels like a long process, because it's not going to jump from 3.6 to 10% overnight. The unemployment number, that is, for example.
Right, but even if it goes to their targets, they're saying maybe 4.5%. That's still a lot. That's like 1 million people or something. What's 1% of the U.S. population? 300 million people. That's 3 million people. That's a lot. And even if that is a normal, or there are plenty of countries that would love to have a 4.5% unemployment rate.
I was going to say, Germany, sorry to interrupt it, but because I just read the number this morning, Germany, we're at 5.6%. So 4.5 is like, what are you, like, who are you kidding?
That is no comfort to it's the rate of change, right? It's no comfort to the people who lose their jobs. And you have that many people out of work, and by the way, they vote. Right? So these are serious issues. Let me rewind for just a second, though. I don't think there is a necessary, and granted, these terms are often defined differently by different people. But I don't see stagflation as being necessarily different from a recession. Stagflation means inflation and weak growth. Well, that could cover not just weak growth, but negative growth. So you can have a stagflationary recession. I think depending on fiscal and monetary responses, it's possible to have a stagflationary depression. It is it's assumed that both recession and certainly depression would cure inflation. Well, they might if the governments didn't respond with a flood of new money. So which force will prove the greater? We'll have to see how it works out. In this context, I think you mentioned a couple of examples. I think the UK is a particularly important bellwether. UK is really showing us the 2020s version of stagflation. What happened in the 70s, history never repeats, even if it rhymes. I think it's important to look at what's happening to the UK right now because we have very high inflation. We have, we have all these problems surging. We have even a central bank, the only major central bank I've ever heard of doing it, saying that they are calling for recession. So this is the poster child for stagflation. Excuse me. Different strokes for different folks. They don't have the reserve currency of the world anymore. But as a sign of things to come, how things play out as UK grapples with stagflation, I think will be indicative for the rest of us in other countries. Excuse me, I got a frog in my throat.
No worries. No, you posted about the United States manufacturing PMI this morning as well, that those numbers came out and those looked abysmal as well. We still have slight growth. It's really this much. If you look at it, the chart, there's barely any. So we don't have negative growth just yet, but it's pretty much non-existent.
Actually, sorry, Kaino, the PMI under 50 marks is negative, and it's one of those above 50, under 50 ones.
Oh, okay. I'm not an expert.
And so that line at the bottom of the chart is 46. So that's not a little bit of positive. That's just the bottom of the chart.
Okay, I'll take it. I was just looking at the graphic. Okay, I'm not an expert on the PMI, but
it's bad. You're right.
Dwindling.
It's bad.
It's dwindling. No, but all the indicators as well, because the question is strong U.S. dollar. Getting a little off topic here, but the strong U.S. dollar is of course causing weaker manufacturing data, in my opinion, because you at least don't export anymore. Although it's cheaper to produce because your U.S. dollar is stronger, but you're not selling to anybody besides domestically.
As you and I speak, I don't know when you'll post this, Kai, how long it'll take you to turn around, but as you and I speak, we're waiting for the Friday jobs report in the U.S. And I know the U.S. is not the entire world, but since we invest in commodities are priced in dollars. We have to care particularly about what happens. And of course, it is the 800-pound gorilla. So this is a very, I think, key jobs report. They're always important. Everybody looks at them. But in this particular time when people are trying to gauge what the Fed will do, like the market odds you were talking about for what that next rate hike will be or won't be, that jobs report will be hugely impactful. And if there's a surprise there, I would expect to see large-scale market movements in response. If it doesn't budge, right? Good news on Main Street, I think will be very bad news on Wall Street. If it does move significantly, if finally what the Fed has done to housing and so on starts impacting those numbers, then you could see true joy on Wall Street because of the pain on Main Street finally starting. But it's one of those be careful what you wish for things. You and I have spoken before about how this whole premise of the soft landing or mild and brief recession that everybody's hoping for is standing on a one-legged stool, which is U.S. labor. Everything else, the U.S. leading indicators, housing, all this stuff is flashing recession, not to mention the massively inverted yield curve. Like everything else says recession except for the jobs numbers. And that's a whole conversation we don't get into. But so if that final leg of the stool starts to crumble, everybody will be like, yay, the Fed could loosen up. But forgetting that, if that's the last leg of the stool, what does that mean for everybody participating in the economy and earnings, everything?
It'll be disaster, to be honest. It's not going to be pretty. It's not going to be pretty. Let's talk. Second to last topic. I need to talk commodities again. Like you brought up recession. I'm looking at commodity prices. Copper, for example, hasn't broken above $4 yet. How much of a recession is already priced in, especially in the base metals? And how are they trading, and what do you expect sort of for 2023 to sort of play out in the base metals primarily?
One of the crazy things about markets is that for some reason, commodities investors, and not just you and I, but like mainstream commodities types on Wall Street in Chicago, they seem to not drink at the same water coolers as the equities guys. And so while markets will look forward through a recession and price that in advance and start moving up even before a recession is done, commodities guys seem to be, or gals, or both, seem to be much later to the party there. And you'd think that they would price the recession in. And certainly the fear of looming recession has not helped commodities prices. But my experience, when it actually happens, when it hits, everybody's like just an anthill that's been stirred up with a stick running around. Oh my God, it's here. It's worse than we thought. And commodities take it on the chin. So I have been guiding my audience to beware of buying any industrial metals until the recession hits and it does its worst. I'm not going to try to time that bottom. And who knows? I might be wrong. It might not play out the way it has in the past. But my experience is that the reality always seems to catch commodities traders by surprise somehow. Even if you see it, years coming, miles coming, whatever, somehow they're like, oh my God, recession. Nobody could have seen this coming. And copper takes it on the chin. Even the ones in short supply. It's not just the ones that are, more abundant, but even ones that are facing structural supply deficits. The traders will trade those prices down. And we have not seen that yet, not in a big way, I don't think. So I see more pain ahead. This includes the platinum group metals as well. I just got a very angry person on Twitter yelling at me because I said something about platinum being an industrial metal, and it's up $75 in the last 12 days. I'm not impressed by the short-term volatility. It is an industrial metal. It's primarily used in, catalytic converters. And, palladium has had quite the fall too. So the replacement pressure is maybe easing up there. Anyway, all industrial metals. I'm not buying any of them. At this point, I am looking to buy more gold and silver, and of course, uranium. I see that as an exception, but industrial metals and even oil, until that recession really hits and we know how bad it's going to be, I think it pays to be cautious.
No, absolutely. Have you made any changes to your portfolio in recent months? Have you shifted a couple things around?
I actually, well, it depends on your recent months. I did buy a couple of oil and gas plays in the latter half of 2022 as the war, continued. I more oil than gas because I thought gas got ahead of itself, and actually, I think that worked out really well. And those have done okay, but the biggest call was more like putting the brakes on copper in particular. I am very bullish on copper. I think if you had the intestinal fortitude to buy a copper stock today, because copper is relatively down and the stocks are on sale, and just stick it in a drawer, a good one, not a junior in a burning match, but like a profitable company that you're not worried about being there years down the road, just stick in a drawer and come back in 10 years, you might do okay. But very, very few people can do that. They're going to see if I'm right and the impending fear of recession turns into the undeniable reality of recession in the mainstream perception, I think that will take all industrial metals lower, including my favorite copper, and the stocks can easily drop 30, 50% or more, even if the fundamentals don't justify that. It's just how markets react or overreact. We've seen it time and time again. I'm not a subscriber to the efficient market hypothesis. They always overshoot one way or the other. And that's how speculators have an opportunity to make money.
Absolutely. No, I'm with you there as well. Really curious to see how this plays out this year, to be honest, because it feels like all the base metals have their brakes on and they're just waiting. It's like the deer in the headlights kind of scenario. They're just waiting for something to happen, and the deer doesn't know if it's going to move or just stand its ground. So that's exactly what it feels like. Lobo, very, very last question. You pinned a tweet this morning and about CBDCs. I just want to ask you, like, how do you really feel about CBDCs, and how does that factor into everything?
You, when Bitcoin came out, I know gold bugs love to hate Bitcoin. A lot of them do, but I actually love the idea of cryptocurrencies. I think governments have been so profligate in their mismanagement of money supply. They should be fired as stewards of the money supply. And I see cryptocurrencies as a market response to government mismanagement of the very serious business of money, which affects everybody in, in the most profound way. We don't need to argue about whether gold is better than Bitcoin. This is relevant. Let the market decide. But that's the market. That's the market response. A government electronic money is a completely different thing. It is an absolute nightmare scenario of Black Mirror proportions. And this isn't just hyperbole. I wish I could feel like I'm being Chicken Little and exaggerating about some science fiction-y nightmare, but it's fact. I mean, look at what China's doing with their social rating. That was a Black Mirror episode. If you don't know what I'm talking about, Google it. Black Mirror social rating. If you if you're not thumbs up enough by your fellow citizens, you can find that you can't buy the apartment in the apartment building you want. But the CBDCs take that information and they give the government the power to reach right into your wallet. Suppose you go to the store and the Surgeon General has decided that you've eaten more red meat than you should have this month. Suddenly, your credit card or your government, your Fed coin card, won't allow you to buy that meat. You got to buy tofu that month or something. And never mind if you say something unpopular. Look at what happened in Canada with the truckers. Now, however you feel about the truckers and making noise or whatever, the way that the governments went and shut down accounts of people who funded, who donated, who supported them. I mean, that's political free speech, and for the government to exercise that kind of control, absolute nightmare. I think the bad news is that this is such an appealing candy. I can't imagine the powers that be failing to reach out and grasp it. The good news is, quoting that great philosopher Princess Leia, the tighter they squeeze their fist, the more systems will slip through. I think the backlash will be when people realize how horrible this is. And if China experiments with it, if the social rating gets linked to your wallet in China and how people feel about that, it could actually be the best thing that ever happens for monetary metals. People will want something that can't be printed, turned on or off by a government. It's physical, there's no electronic trace. I'm not making a prediction. I'm just saying it could be something that, on the other side of the nightmare turns out to teach a world a much needed lesson.
Lobo, what a great conversation. Like, I have nothing further to add. I really, really enjoyed our conversation. It was good banter back and forth here. And it's been 33 minutes. Fantastic. Like, I didn't even notice how time flew past. It's really enjoyed it. Maybe one last question. Gun to your head. If you had to make one call that's going to turn out as you predict, gun to your head, what would it be?
Uranium. I'm still on uranium. I mean,
Yeah.
obviously, absent another Chernobyl type event, that aside, it just the tide has turned. Even Greta Thunberg says that Germany should keep its reactors on. I mean, this is an idea whose time has come.
Absolutely. I didn't want to talk uranium. Like, I would have asked you uranium, but you've done a fantastic interview with David Lynn over at Kitco just about 2 weeks ago. I didn't have anything fresh to add there. That's why I didn't sort of add to it. But everybody else, definitely check it out. It was a great conversation. I listened to it prior to our conversation here as well. So, Lobo, thank you so much. I wish you all the best in 2023. Wealth and health, as you said. I'm going to steal it, as I said. And appreciate your time. Thank you so much for joining us.
Thank you, Kai, and all the best to the audience as well.
Fantastic. Everybody else, thank you so much for tuning in. We hope you enjoyed this conversation with Lobo Tiggre. Make sure to check out the Independent Speculator. Lobo is also quite active on Twitter at DEUTSCHE, so make sure to follow him there as well. And to leave us a comment, leave us a like, and of course, subscribe to the channel. Roughly 85 to 90% of you are not subscribed who are watching. Let's change that number. Let's bring that number down, and we'll get more like-minded viewers to join in and chime in and comment below, and we'll get a good discussion going. What do you think is going to happen in 2023? Put it in the comments. Happy to discuss it with you, and we'll be back with lots more great content. Thank you so much for joining us.